$38 trillion. That is the colossal scale of the United States' national obligations as we stand here today on January 5th, 2026. This isn't a speculative forecast for the coming year or an abstract projection. It is the concrete, actual debt recorded on the official ledger as we begin 2026. If you harbor the belief that this staggering figure has no bearing on your daily life, I urge you to pay close attention to the details I'm about to share. While the general public has been preoccupied with social media feeds and streaming entertainment, the world's most powerful financial entities have initiated a maneuver not seen in 3/4 of a century. They are quietly and methodically shifting massive volumes of capital away from assets priced in US dollars. This isn't some fringe conspiracy theory. It is a reality backed by documented capital movements, public regulatory filings, and official Treasury data. Information you can audit yourself right now. By the conclusion of this presentation, you will grasp precisely what is occurring, the underlying drivers, and most critically, the inevitable sequence of events to follow. We are witnessing a recurring mathematical template that has manifested 3 times over the last half-millennium. Each time it features the same progression, identical red flags, and the same catastrophic conclusion. We are watching this cycle repeat in real time as 2026 unfolds. The only remaining uncertainty is whether you will recognize the momentum, or if you will eventually join the millions who preceded you in wondering how the signs were ignored. Stay with me, because the next 15 minutes will fundamentally reshape your perception of global finance. The aggregate global debt has recently surpassed $251 trillion, according to the latest figures from the International Monetary Fund. This represents 235% of the total global economic output, the highest debt-to-GDP ratio ever recorded during a time of peace. Looking specifically at the United States, the national debt surged from $36.1 trillion at the start of last year to $38.4 trillion by the close of 2025. That was an expansion of $2.3 trillion in a mere 11 months. However, there is a historical context that remains largely undiscussed. This exact financial trajectory has occurred 3 times in the modern era. In every instance, the nation possessing the primary reserve currency experienced a total systemic collapse within 36 months of smart money beginning its departure. These weren't just similar downturns, they were identical progressions with the same stages and the same ultimate results. The sequence is mathematical and highly predictable, and once it hits a specific threshold, it becomes impossible to arrest. Let me walk you through the 4-stage cycle that has defined every major economic downfall over the past 500 years. Stage 1 is the ascension phase. During this period, a specific nation emerges as the epicenter of the global financial world. Capital streams in from every corner of the globe. Their currency is adopted as the universal benchmark for international commerce. Everyone seeks a piece of the action. Banking sectors expand, markets thrive, and a wave of innovation makes the future seem limitless. Confidence in the system is absolute. Typically, this era of dominance lasts between 50 and 80 years. Stage 2 is the overextension phase. Success eventually leads to a sense of invincibility. The government begins to spend far beyond its actual tax revenue. This involves vast military growth, interventions in foreign territories, and massive domestic social programs, all financed through borrowed funds. Debt begins to outpace economic growth, but the warning signs are ignored because the price of assets like stocks and real estate continues to climb. A general sense of wealth permeates society, and central banks keep the engine running by printing more currency. This phase generally persists for 20 to 40 years. Stage 3 is the silent exodus. This is the pivotal moment. The sophisticated investors, those who actually analyze balance sheets, see the writing on the wall, even as the public and politicians remain oblivious. Large institutional players begin to quietly rotate their wealth out of the country. There are no grand announcements, just a calculated systematic migration of capital into safer jurisdictions. Foreign partners reduce their holdings and wealthy families move their assets internationally. It starts as a trickle and then accelerates. This critical window usually lasts between 18 and 36 months. Stage 4 is the final collapse. The currency is stripped of its reserve status. Foreign central banks liquidate their holdings en masse. Inflation moves from a crawl to an explosion, interest rates skyrocket, and asset prices crater simultaneously. Banking systems freeze, retirement funds are wiped out, and the middle class is essentially liquidated. This leads to profound political instability, leaving everyone to ask, how did we not see this coming? The reality is that the pattern was visible the entire time. To prove this isn't just theory, let's examine 3 historical giants that fell through this exact cycle. First, consider 16th century Spain. At that time, it was the undisputed superpower of the world. Spanish ships returned from the New World overflowing with unprecedented quantities of gold and silver. The Spanish real was the global standard. If you wanted to do business, you needed that currency. Madrid was the heart of the financial universe. Stage 1 was fully realized. King Philip II governed half of Europe. His invincible armada dominated the oceans, and riches flowed in from colonies across 3 continents. Yet they squandered it on endless warfare, battling France, England, the Ottomans, and the Dutch. They maintained a massive military and a bloated bureaucracy that bled the treasury dry. By 1550, the Spanish government was spending 300% of its actual income. They bridged the gap by borrowing from Italian and German financiers. Because gold was still arriving, no one panicked. Asset prices stayed high and the empire felt eternal. Stage 2 was verified. Then, in 1555, a subtle shift occurred. The most influential banking families began shifting their wealth to Genoa. The Fuggers, Spain's primary lenders, started demanding payment in physical gold rather than government promises. By 1556, prominent merchants were moving their bases to Amsterdam. They were reading the fiscal data, which showed that Spain was effectively bankrupt and paying 40% interest on its loans, a clear sign of terminal desperation. Stage 3 was documented. In 1557, Spain defaulted on its debt. Credit markets locked up, and the government began seizing private gold to pay its troops. Despite the king's claims that it was a temporary glitch, Spain defaulted again in 1560, 1575, 1596, and 1597. The currency failed, inflation decimated the population, and Spain's status as a superpower vanished, never to return. Stage 4 was complete. The wealth then migrated to the Dutch Republic in the 1600s. Amsterdam became the new financial capital. The Dutch East India Company was worth the equivalent of $8.28 trillion today, larger than the modern tech giants combined. They pioneered the stock exchange, and the Dutch guilder became the world's reserve currency. Amsterdam was the Silicon Valley and Wall Street of its day. This was stage 1, but then came the costs of global reach and 3 Anglo-Dutch wars. Debt skyrocketed from 4 million guilders in 1650 to 80 million by 1690. To fund this, they printed money. Meanwhile, speculative bubbles like tulip mania took hold, with flower bulbs selling for more than homes, a complete detachment from reality. The Bank of Amsterdam was secretly using depositor funds to bankroll government deficits. Stage 2 was in full swing. By 1690, the smart money was moving to London. Jewish and Portuguese merchants relocated their operations. The insiders knew the Bank of Amsterdam was insolvent. Stage 3 was verified. Finally, in 1795, the system collapsed entirely during the French invasion. The bank's fraud was revealed, savings were lost, and the Dutch Golden Age ended in a matter of months. Stage 4 was complete. The cycle moved to the British Empire. From the 1700s to the early 1900s, Britain was the global titan. The pound sterling was the reserve currency for over 2 centuries. London financed the world's infrastructure, and over 60% of trade was settled in pounds. This was stage 1 at its peak. However, the 20th century brought 2 world wars. The First War cost Britain the equivalent of $600 billion today, pushing their debt to GDP from 30% to 130%, the exact level the U.S. occupies now. World War II finished the job, leaving Britain technically victorious but financially bankrupt and dependent on American credit. Stage 2 was reached. In 1949, the silent exodus began as major firms like Shell and Unilever began shifting focus to the U.S. Wealthy families moved assets to Switzerland and Canada to escape high taxes. Between the 1940s and 60s, a brain drain saw talent flee to America. Stage 3 was verified. In 1967, the pound devalued by over 14% in a single day. By 1976, the former global superpower was forced to ask the IMF for a bailout. The pound was dethroned, and the British century was over. Stage 4 was complete. Now, let's look at the United States today. In 1944, the Bretton Woods Agreement established the dollar as the global reserve, backed by gold. After World War II, capital flooded into America. This was our golden age lasting until 1971, stage 1 complete. In 1971, Nixon removed the gold backing, turning the dollar into a pure fiat currency based only on trust. Without the gold constraint, spending went parabolic. In 1980, debt was $900 billion. By early 2026, it has crossed the $38.4 trillion mark, a 4,200% increase. When you add in corporate, household, and other debts, the total is over $100 trillion, or 370% of GDP. History shows that Spain fell at 200%, the Dutch at 250%, and Britain at 130%. We are well past the danger zone. We now spend over $1 trillion annually just on interest, more than we spend on our entire military. To pay for this, we print money. The M2 supply increased 40% in just 2 years recently, leading to the massive inflation and asset bubbles we see now. Stage 2 is undeniably complete. We are currently in stage 3, the exodus. China has reduced its U.S. Treasury holdings by over $300 billion in the last decade. Japan has sold off $220 billion since 2022. Even the Federal Reserve has been reducing its balance sheet through quantitative tightening. If foreign nations aren't buying our debt at the same rate, who is? The U.S. government is essentially buying its own debt with printed money, a circular Ponzi scheme. Meanwhile, the world's largest asset managers like BlackRock and JP Morgan have been restructuring portfolios to diversify into international infrastructure, emerging markets, and gold. They are moving the smart money out, just like the financiers did in Spain, Amsterdam, and London. Furthermore, as we enter 2026, market expectations for Federal Reserve rate cuts are rising. While this might temporarily boost markets, it historically accelerates the debasement of the currency, making non-dollar assets like gold even more attractive to those seeking to preserve wealth. Stage 3 is happening right now. Stage 4 involves the dollar losing its reserve status. It won't happen all at once, but gradually, then suddenly, countries are already bypassing the dollar. The BRICS nations are building their own payment systems. There has been much talk about the petrodollar ending. While there was no single expiration date, the reality is that Saudi Arabia is now open to accepting other currencies for oil. This fractures the dollar's monopoly. When global demand for the dollar falls, those trillions held overseas will flood back into the U.S. economy, causing vertical inflation. The Fed will then face a choice: raise rates to save the currency and crash the economy, or print more and cause hyperinflation. Either way, the middle class loses everything. Don't fall for the trap of American exceptionalism. Spain had the best military, the Dutch had the best tech, and Britain had the biggest empire. None of that stopped the math of economic collapse. Printing money didn't save Weimar Germany or Zimbabwe, and it won't save us once confidence breaks. So, what is the practical plan for you, starting today in January 2026? First, realize that if your wealth is entirely in dollar-denominated assets, you're exposed. Diversification into gold, silver, and commodities is about survival, not just profit. Gold, in particular, remains a primary focus for experts as rate cut hopes grow. Second, look at geographic diversification. Consider holding some capital in stable jurisdictions like Singapore or Switzerland. Third, realize that stage 3 usually lasts 18 to 36 months, and we are likely already a year and a half into it. You have months, not years, to prepare. Fourth, maintain liquidity. Cash is losing value, but it gives you the ability to move when markets crash. Fifth, aggressively reduce your personal debt before interest rates move structurally higher or the system freezes. Sixth, invest in your own skills. Your ability to produce value is the only asset that cannot be inflated away. Finally, stay informed. The people who survive these shifts are those who recognize the pattern before it becomes a headline. The $38 trillion debt exists for a reason. The selling by central banks is happening for a reason. The smart money is leaving for a reason. We are in the silent exodus. Stage 4 is the mathematical inevitable conclusion. The only variable is your own preparation. Don't forget to subscribe and stay ahead with the latest market updates.